On the day following Trump's victory, US stocks rallied sharply, hitting record highs across all three major indexes. History shows us that volatility, especially around major elections, can present unique investment opportunities. Here are some key principles to guide your investment strategy during uncertain political times. Number one is to focus on defensive sectors. In periods of uncertainty, defensive sectors such as consumer staples, healthcare, and utilities tend to be safer bets. These industries produce goods and services that remain in demand regardless of the economic fluctuations. During Trump's first term, even as certain sectors wavered, consumer staples and healthcare showed resilience. With renewed expectation of deregulation and pro-business policies, healthcare could particularly benefit this time around, especially in the pharmaceutical and biotech segments where Trump has historically pushed for more innovation-friendly regulations. Likewise, utilities offer stability with their steady cash flows, often distributing dividends to shareholders, which can act as a cushion against broader market dips. For investors seeking lower risk opportunities, these sectors can provide both stability and income for you. Number two is to keep an eye on infrastructure and energy. If Trump follows through on his campaign promises to boost domestic energy production and modernize American infrastructure, these areas may see significant growth. Infrastructure stocks, which include companies involved in construction, engineering, and raw materials, could become valuable holdings, as Trump has already hinted at a renewed focus on American projects. In his first term, energy stocks surged due to deregulation efforts, and similar trends could emerge. However, remember that energy stocks, particularly in oil and gas, can be sensitive to global oil prices and geopolitical tensions. Balancing investments in traditional and renewable energy could be a great way to capture potential gains whilst hedging against longer-term shifts towards green energy. Number three is to diversify with international and emerging market exposure. Trump's re-election is likely to increase volatility within US markets, especially as trade policies take shape. If new trade tariffs or trade barriers are introduced, it could strain certain industries and drive up inflation. By diversifying your portfolio to include international stocks, especially in emerging markets that stand to benefit from less dependence on the US, you could reduce your risk exposure to American-centric market shock. During Trump's previous term, emerging markets in Asia and South America often saw gains when US-centric risks materialized. For this reason, it's worth considering ETFs that track indexes in these regions, which will provide you with diversification without the need to buy individual international stocks. However, do be mindful of currency risk fluctuations in emerging market economies, which can add another layer of volatility. Number four is to embrace dollar cost averaging to reduce your risk. So, one of the simplest yet most effective ways of navigating a volatile market is through dollar cost averaging. This investment strategy involves investing a fixed amount of money at regular intervals, regardless of the market's current state. By investing a set amount consistently, say weekly, monthly, or quarterly, you automatically buy more shares when the price is low and fewer shares when the price is high, effectively lowering your average cost per share over time. Dollar cost averaging is particularly helpful during periods of heightened uncertainty, like the beginning of Trump's second term. In the past, significant political events have triggered short-term market volatility, causing many investors to pull out, only to miss out on the potential gains. With dollar cost averaging, you do eliminate the need to time the market, and investors focus on a disciplined approach that capitalizes on the natural ebbs and flows of the stock prices. So in practice, let's say you invest $500 every month in the S&P 500 index fund. If the market drops one month, your $500 buys more shares at a lower price. When the market rises, those shares previously purchased gain value. Over time, this averaging effect can reduce the impact of short-term price swings, allowing you to accumulate wealth steadily even when the market is unpredictable. Number five is to remember the power of staying invested and those two magic items: compound interest and long-term gains. One of the most valuable concepts in investing, especially during volatile times, is compound interest. This is a principle by which your earnings generate more earnings over time, accelerating the growth of your investment. For this reason, Albert Einstein allegedly called it compound interest the eighth wonder of the world, and for good reason. It rewards those who stay in the market consistently, even when times are tough. As you may recall, when Trump first took office in 2016, there was a mix of optimism and fear. Many investors who reacted emotionally by selling off stocks during periods of turbulence missed out on a prolonged bull market that followed, which saw the S&P 500 gain over 50% by the end of his term. Yes, in 4 simple years. To illustrate how powerful compound interest is, let me share this example with you. If you invest $10,000 now, with a 7% annual return, which in honesty is a conservative estimate based on the long-term historical growth of stock markets, your investment could grow to around $81,000 in the next 30 years. If you invest more regularly, your gains compound even faster. The key is staying invested regardless of short-term political economic shifts to allow that compound interest to work its magic. It is natural for most people to want to time the market during times of uncertainty, trying to sell high and buy low. However, research consistently shows us that timing the market is not only incredibly challenged, but often leads to lower returns. Missing just a handful of the market's best performing days can drastically impact your long-term gains. According to a report by JP Morgan, if an investor just missed the 10 best days in the stock market over a 20-year period, their total returns would have been cut nearly in half. By staying invested and by regularly contributing even just a small amount through dollar cost averaging, you position yourself to benefit from both market recoveries and the long-term growth that compound interest provides. Markets may fluctuate in the short term, but over the long term they tend to rise. Maintaining this perspective is essential for those looking to build wealth even when the political landscape is uncertain. And to this point, I've been dollar cost averaging £25 a week into the S&P 500 since April, and I'm already up 12%, which is incredible. Number 5 is to build up your cash position. In uncertain times, having a strong cash position is invaluable. Cash gives you the flexibility to react quickly to market dips or new opportunities without needing to sell off existing investments at potentially unfavorable prices. As Warren Buffett famously advises, cash is like oxygen. It's essential when the market drops, giving you the ability to buy high quality stocks at low prices. Maintaining a cash position around 10 to 20% can provide the flexibility needed to capitalize on volatility without overcommitting your portfolio to high risk moves. This approach also helps to mitigate psychological temptations to panic sell, as you have the liquidity available to take advantage of market lows. And finally, number 6 is to consider safe haven assets like gold and bonds. With treasury yields expected to rise and inflation concerns on the horizon, safe haven assets like gold and silver and treasury inflation protected securities are worth considering. Historically, gold prices surged during times of political and economic uncertainty, and given the potential for inflation and higher deficits under Trump's policies, it's reasonable to expect similar trends. We have already seen a large gold rally this year, and I personally expect this to continue. Invest in bonds, particularly short to medium-term government bonds, can also add stability to your portfolio. With interest rates predicted to rise, shorter-term bonds are less sensitive to rate changes and provide more predictable returns. And whilst bonds and gold might not offer the same growth potential as stocks, they can serve as essential anchors in volatile markets.
Thank you very much. Wow.